The United States dollar is experiencing its worst year in 4 decades, down 10% since January, bleeding value faster than any currency collapse we've seen in modern history. And here's what nobody's telling you. This isn't a correction. This isn't a cycle. This is stage 8 of a 9-stage process that has destroyed every reserve currency in human history, and we're watching it happen in real time. The British pound held global dominance for over a century before it collapsed in 18 months. The Spanish real-controlled world trade for 200 years before it vanished in a decade. The Roman aureus backed an empire for 4 centuries before it became worthless metal. Every single reserve currency that has ever existed has followed the exact same pattern. 9 stages. 9 predictable steps from dominance to destruction. And the United States dollar has just entered stage 8. Most people think currency collapse happens overnight. Governments default, economies crash, chaos erupts. But that's not how it works. Currency collapse is a process, a sequence, a mathematical progression that plays out the same way every time. And once you understand the pattern, once you see the stages, you realize we're not heading toward collapse. We're already inside it. Here's what should terrify you. Stage 8 is the acceleration phase. This is where decades of gradual decline compress into months of rapid destruction, where confidence evaporates, where alternatives emerge, where the mathematics of debt and debasement reach a tipping point that becomes irreversible. And every indicator, every data point, every warning signal is flashing red simultaneously. The dollar lost more value in the first half of 2025 than in any 6-month period since 1973. Foreign central banks are dumping dollar reserves at record rates. America's national debt has exploded past $38 trillion, adding $1 trillion every 5 months. Interest payments alone now cost more than national defense. And for the first time in history, a coordinated alternative system is emerging with the economic power to actually challenge dollar dominance. This is the story of how reserve currencies die. Not through war, not through revolution, but through mathematics, through the inevitable progression from stages 1 through 9. And I'm going to show you exactly where we are, exactly what comes next, and exactly how fast it happens once stage 8 completes. Before we go through the stages, you need to understand what reserve currency collapse actually means. Not in textbooks, in practice. When a reserve currency fails, it doesn't just affect one country. It reshapes the entire global financial system. Trade routes change, alliances shift, power transfers from one empire to another, and everyone holding the old currency loses everything. The British pound was the world's reserve currency from 1815 to 1944. 129 years of absolute dominance. Every major trade contract was denominated in pounds. Every central bank held British bonds. London was the financial centre of the world. And then World War I started. Britain spent $40 billion fighting Germany. That's over $1 trillion in today's money. They borrowed from everyone, mostly from the United States. By 1918, Britain owed America more than their entire gross domestic product. But they'd won the war. They kept the empire. They thought they could rebuild. They were wrong. The pound never recovered. By 1944, Britain was broke. The empire was collapsing. And at the Bretton Woods Conference, the dollar officially replaced the pound as the world's reserve currency. 129 years of dominance ended in 26 years of managed decline. The Spanish real-controlled global trade from 1500 to 1700. 200 years of silver flowing from the Americas into Spanish coffers. The real was accepted everywhere. Spanish merchants dominated international commerce, and then the silver mines depleted. The real lost its backing. Within 50 years, Spain went from global superpower to regional player. The currency that once bought half the world became worthless paper. The Roman aureus backed the greatest empire in human history for over 4 centuries. Roman coins were trusted from Britain to India. Roman merchants operated on every continent. Roman financial networks connected the civilized world, and then the empire overextended. Military costs exploded. They debased the currency, mixed copper into silver, reduced gold content, printed more money to pay soldiers. Within a century, the aureus was gone. The empire followed shortly after. 3 reserve currencies, 3 different eras, 3 identical patterns: military overextension, unsustainable debt, currency debasement, loss of confidence, alternative systems emerging, and collapse. Not gradual, not graceful, but sudden and complete once the final stage triggers. Now here's the pattern. The 9 stages every reserve currency follows. Stage 1, dominance. The currency is universally accepted. Trade flows through it. Central banks hold it. It's the global standard. Stage 2, overextension. The issuing country takes on military and financial commitments beyond its capacity. Costs exceed revenues. Borrowing begins. Stage 3, debasement. Unable to fund commitments through taxes, the government prints money. Currency supply expands. Real value per unit declines. Stage 4, competition. Other currencies begin gaining acceptance. Trade starts diversifying. Central banks begin holding alternatives. The monopoly cracks. Stage 5, crisis events. Wars, economic shocks, political instability. Events that test the currency's resilience and reveal its weakness. Stage 6, acceleration. Decline speeds up. Confidence erodes faster. Alternatives gain momentum. The tipping point approaches. Stage 7, institutional breakdown. The systems supporting the currency begin failing. Central banks stop cooperating. International agreements collapse. The infrastructure crumbles. Stage 8, terminal collapse. Rapid, devastating decline. Confidence disappears overnight. Alternatives take over. The currency dies. Stage 9, aftermath. New systems emerge. Power transfers. The old currency becomes historical curiosity. This isn't theory. This is documented historical fact. And the United States dollar is currently in stage 8. Let me show you the evidence. The dollar's share of global central bank reserves has fallen to 56.3%, the lowest level since 1994, down from over 85% in 1977. Foreign central banks are actively diversifying away from dollar holdings. China reduced its treasury holdings by over $100 billion in the past year. Russia eliminated virtually all dollar reserves. Even allies like Germany and France are reducing dollar exposure. America's debt crisis has reached mathematical impossibility. $38 trillion in total debt, $1.2 trillion in annual interest payments. That's more than defense spending, more than Medicare, more than anything except Social Security. And interest rates are still elevated. If rates stay at 5%, interest payments will hit $1.8 trillion by 2027. That's 6% of gross domestic product, just interest, not principal, just interest. The Congressional Budget Office projects $13.8 trillion in interest costs over the next decade alone. There is no scenario where this gets paid back through normal means. You cannot tax your way out of debt exceeding 130% of gross domestic product. You cannot grow your way out when debt is growing faster than the economy. You cannot cut spending when interest alone consumes 6% of gross domestic product. But here's what makes Stage 8 different from the previous 7 stages. For the first time in history, a credible alternative system is operational and expanding. The BRICS nations now control 38.8% of global gross domestic product. When combined with partner states, they represent 46% of global gross domestic product and 55% of world population. This isn't a small group of developing countries. This is an economic bloc larger than the existing Western financial system. China's cross-border interbank payment system now connects 4,800 banks across 185 countries. Russia and China conduct over 90% of their bilateral trade in rubles and yuan. No dollars involved. Saudi Arabia is accepting yuan for oil payments. India is buying Russian energy with rupees. The infrastructure for dollar alternatives isn't theoretical anymore. It's operational and growing rapidly. The Federal Reserve faces an impossible choice that reveals why Stage 8 becomes terminal. They can raise interest rates to defend the dollar, which would crash the economy under $38 trillion in debt. Or they can cut rates to support growth, which accelerates currency debasement and inflation. There's no middle ground. Every policy option makes the situation worse. Current Fed policy proves this paralysis. They cut rates in December while inflation runs at 3%, well above their 2% target. They're prioritizing short-term economic stability over long-term currency stability. This is exactly what central banks do in Stage 8. They sacrifice the currency to prevent immediate collapse, which guarantees eventual collapse. The mathematics are brutal. America spends 40% more than it collects in taxes. This isn't a temporary budget problem. This is structural insolvency. The government must borrow $1.8 trillion annually just to maintain current operations. And that's before any crisis hits, before any recession, before any emergency spending. The baseline scenario is already unsustainable. But Stage 8 isn't just about government debt. It's about the entire dollar ecosystem breaking down simultaneously. Foreign investors hold over $30 trillion in dollar-denominated assets. European investors alone hold $8 trillion in American bonds and stocks. For decades, they held these assets unhedged, betting the dollar would strengthen. Now they're adding currency hedges at record rates. That means selling dollars to protect against losses. When foreign investors hedge their dollar exposure, they're essentially shorting the currency. $8 trillion in European holdings alone. If even 20% gets hedged, that's $1.6 trillion in dollar selling pressure. The currency can't absorb that kind of systematic liquidation without collapsing. The bond market is already showing stress. Treasury auctions are seeing reduced foreign participation. Bid-to-cover ratios are declining. Primary dealers are having to absorb larger portions of issuance. These are early warning signs that the market is losing appetite for American debt. When that appetite disappears completely, the government can't finance operations. That's the moment Stage 8 becomes Stage 9. Here's what most people don't understand about currency collapse. It doesn't happen because the economy fails. It happens because confidence fails, and confidence can disappear in hours, not years. The British pound was stable until September 1992, then George Soros bet against it. The Bank of England spent $15 billion trying to defend the currency. They failed. In one day, the pound crashed 25%, and Britain was forced out of the European exchange rate mechanism. The dollar faces a much more dangerous scenario. This isn't one speculator attacking. This is systematic diversification by the world's largest economies. China holds the world's second largest economy. Russia controls massive energy resources. India has the largest population. Saudi Arabia controls oil pricing. Brazil dominates South American trade. These aren't speculators. These are sovereign nations with permanent strategic interests in reducing dollar dependence. The acceleration is visible in real-time data. Gold hit record highs, surging past $2,700 per ounce. Silver exploded 66% year-to-date, reaching $50 for the first time in history. Bitcoin touched new all-time highs above 100,000. These aren't random price movements. This is capital fleeing fiat currency for hard assets. This is the debasement trade in action. Ken Griffin, founder of Citadel, one of the world's largest hedge funds, publicly stated that investors are fleeing the dollar for hard assets because the currency has lost 10% of its value since January. When billionaire hedge fund managers make public statements about dollar weakness, it signals that institutional confidence is breaking. The Federal Reserve's own data confirms the crisis. The dollar index fell 11% in the first half of 2025, the biggest six-month decline since 1973. Morgan Stanley projects another 10% decline through 2026. That would represent a 21% devaluation in just 2 years. No reserve currency in history has survived that kind of systematic decline. Regional Federal Reserve presidents are publicly disagreeing about monetary policy. Some want aggressive rate cuts to support the economy. Others want rate increases to combat inflation and defend the currency. This internal division signals that the Fed has lost consensus on how to manage the crisis. Central bank credibility depends on unified messaging. When that breaks down, market confidence follows. The timing of Stage 8 is accelerating because multiple crises are converging simultaneously. The debt crisis creates fiscal pressure. The inflation crisis creates monetary pressure. The geopolitical crisis creates international pressure. The confidence crisis creates market pressure. Any one of these could be managed individually. All four together create systemic breakdown. International payment systems are bypassing dollars at unprecedented rates. The SWIFT network, dominated by dollar transactions, is losing market share to alternatives. China's CIPS system processed over 80 trillion yuan in transactions last year. Russia's SPFS system connects over 500 banks across 20 countries. These aren't experimental systems anymore. They're operational infrastructure handling real trade flows. The oil market is shifting away from dollar pricing for the first time since the 1970s. Saudi Arabia's currency swap agreements with China allow oil purchases in yuan. Russia sells energy to India in rupees. Iran trades oil with China in yuan. The petrodollar system that has supported dollar demand for 50 years is fragmenting in real time. Corporate behavior reveals private sector recognition of Stage 8 conditions. Major multinational corporations are restructuring their treasury operations to reduce dollar exposure. They're holding larger cash positions in euros, yen, and yuan. They're negotiating supply contracts in local currencies rather than dollars. They're essentially hedging against their own country's currency. The velocity of change distinguishes Stage 8 from earlier stages. Previous stages developed over years or decades. Stage 8 compresses this timeline into months. Social media and algorithmic trading accelerate information flow. When confidence breaks, it breaks globally and simultaneously. There's no time for gradual adjustment or policy intervention. Employment data reveals economic stress beneath surface statistics. The Federal Reserve's Beige Book reports widespread concern about inflation, reduced business investment, and declining consumer spending power. Real wages are falling as inflation outpaces wage growth. Consumer debt is reaching record levels as people borrow to maintain living standards. These are classic symptoms of currency crisis impacting the real economy. The international banking system is preparing for dollar instability. Central banks increased gold purchases to record levels in 2023 and 2024. Commercial banks are expanding their precious metals trading operations. Even domestic American banks are quietly building positions in alternative currencies and hard assets. Stage 8 represents the mathematical point where debt service costs exceed the government's ability to generate revenue through normal economic activity. Interest payments of $1.2 trillion annually on a $27 trillion economy means 4.4% of total economic output goes just to servicing debt. When that percentage reaches 6%, which current projections show happening by 2027, the mathematics become impossible. The compound effect accelerates the timeline. Higher debt requires higher interest payments. Higher interest payments increase the deficit. Larger deficits require more borrowing. More borrowing increases total debt. Higher debt leads to higher interest payments. This feedback loop becomes self-reinforcing and mathematically explosive. Foreign policy consequences of Stage 8 are already manifesting. American diplomatic influence is declining as economic leverage weakens. Sanctions become less effective when countries can trade outside the dollar system. Military commitments become harder to sustain when financing becomes problematic. The empire contracts as the currency that supports it fails. The psychological component of Stage 8 cannot be quantified, but determines the timeline. Currency collapse is ultimately a confidence phenomenon. When enough people believe the currency will fail, their actions make failure inevitable. This process can remain stable for years, then trigger overnight when critical mass is reached. Mass is reached. Market psychology operates on predictable patterns that have played out identically across centuries of currency failures. The Spanish merchants who accepted reals in 1650 didn't wake up one morning deciding their currency was worthless. The British bankers holding pounds in 1939 didn't suddenly lose faith overnight. The process unfolds through observable stages of collective consciousness shift. First comes institutional doubt. Central bankers begin private conversations about alternatives. Treasury officials run contingency scenarios. Finance ministers hold closed-door meetings about currency diversification. This phase remains invisible to the public, but shows up in policy changes and international agreements. Second comes market positioning. Professional investors start hedging currency exposure. Corporations renegotiate contracts to include currency protection clauses. Pension funds quietly diversify into alternative assets. The smart money moves first, but quietly enough to avoid triggering panic. Third comes public awareness. Media begins covering currency weakness as a serious story rather than temporary fluctuation. Academic economists publish papers about reserve currency transitions. Politicians start mentioning alternatives in speeches. The narrative shifts from if to when. Fourth comes behavioral change. Citizens begin converting savings into hard assets. Businesses start pricing goods in multiple currencies. International travelers notice their money buys less abroad. The currency crisis moves from abstract policy discussion to daily experience. Fifth comes systemic rejection. Foreign governments announce reduced dollar usage. Major corporations switch to alternative currencies for international contracts. Central banks stop buying treasury securities. The institutional framework supporting the currency begins active dismantlement. The United States is currently transitioning from Phase 3 to Phase 4. Public awareness has reached critical mass. Behavioral change is accelerating. The next phase represents the point of no return. Consider the mathematical momentum building behind this transition. America's fiscal deficit requires borrowing $1.8 trillion annually. Foreign investors must purchase this debt to maintain the current system. But foreign appetite is declining precisely when foreign capacity to purchase is needed most. China's treasury holdings fell from over $1 trillion to under $800 billion. Japan reduced holdings from $1.3 trillion to $1.1 trillion. These are the two largest foreign creditors voluntarily reducing their exposure. The timing creates a perfect storm. American borrowing needs are increasing while foreign willingness to lend is decreasing. This gap must be filled either by domestic investors, which crowds out private investment, or by Federal Reserve purchases, which accelerates currency debasement. Neither option maintains currency stability. Domestic savings cannot absorb the required debt issuance. American households hold roughly $100 trillion in total assets, but most is illiquid real estate and retirement accounts. Available liquid savings amount to approximately $15 trillion. The government needs to borrow nearly $2 trillion annually. That represents 13% of total liquid savings every single year, mathematically impossible to sustain. Federal Reserve intervention creates the debasement trap that has destroyed every previous reserve currency. When central banks buy government debt with newly created money, they're essentially printing currency to finance government operations. This worked when the dollar was backed by gold because gold provided a constraint on money creation. Without that constraint, money printing becomes unlimited. The Federal Reserve's balance sheet expanded from $900 billion in 2008 to nearly $9 trillion at its peak. That represents a tenfold increase in the monetary base. The only reason this didn't cause immediate hyperinflation was global dollar demand absorbing the new supply. But as that demand declines, the excess supply becomes inflationary pressure. Current inflation data understates the real debasement occurring. Official Consumer Price Index measures specific basket of goods using methodology designed to minimize reported inflation. Real inflation, measured by asset prices, housing costs, and import prices, runs significantly higher than official statistics suggest. Food prices have doubled in many categories. Housing costs have tripled in major markets. These are currency debasement effects disguised as supply chain problems. The international comparison reveals how severe dollar debasement has become. The Swiss franc gained 15% against the dollar in 2025. The Norwegian krone gained 12%. Even the euro, despite its own problems, gained 8%. When the reserve currency weakens against multiple alternatives simultaneously, it signals systematic rather than cyclical decline. Energy markets provide the clearest evidence of dollar rejection accelerating. Oil prices in dollar terms have increased 40% year over year, but oil prices in yuan, euros, and gold have remained relatively stable. This suggests the price increase reflects dollar weakness rather than oil scarcity. Energy producers are essentially demanding more dollars to compensate for dollars being worth less. The petrodollar recycling system that supported dollar demand for 50 years is fragmenting rapidly. Saudi Arabia historically invested oil revenues in treasury securities and American banks. Now they're diversifying into Chinese bonds, European assets, and gold reserves. This removes a major source of structural dollar demand that had operated automatically since 1973. Corporate treasury operations reveal private sector preparation for currency instability. Apple holds over $60 billion in foreign currency deposits. Microsoft maintains substantial euro and yen positions. Google has diversified cash holdings across multiple currencies. These companies have better intelligence than government agencies and are positioning for dollar decline. The derivatives market shows sophisticated investors betting heavily against the dollar. Currency swap volumes have exploded as institutions hedge dollar exposure. Options markets show massive put positions on dollar index funds. Credit default swaps on treasury securities are trading at levels not seen since the financial crisis. Professional money is positioning for currency failure. Regional Federal Reserve economic surveys confirm the crisis is impacting Main Street America. Small businesses report difficulty planning due to currency volatility. Manufacturers struggle with input cost inflation caused by dollar weakness. Retailers face margin compression as import costs rise faster than consumer prices. The currency crisis is becoming an economic crisis. Labour market distortions reveal how currency debasement destroys middle-class prosperity. Nominal wages appear to be rising, but real purchasing power is declining. Workers need higher salaries to afford the same lifestyle they had 5 years ago. This creates persistent labour shortages as people cannot afford to work at previous wage levels. The economy appears healthy on paper while living standards collapse. We're watching the endgame unfold in real time. Stage 8 of reserve currency collapse isn't a distant threat or theoretical possibility. It's happening now, accelerating faster than any historical precedent. The mathematics are inescapable, the timeline is compressing, and the alternatives are already operational. When Stage 9 triggers, the world you knew disappears overnight. The only question remaining is whether you'll be prepared for what comes next.